If you want to know how to scale a multifamily portfolio, you have to check out today's conversation on multifamily mastery. We sit down with Paul Kaseburg and he breaks down some of the key strategies and tactics they've used to scale the 32,000 unit portfolio across the Western United States. Now, Paul gets into how they find deals, how they analyze deals, and how they ensure that they stand out to get that last phone call from brokers. On top of that, he shares ways of building his team culture and making sure they drive great operations. If you want to learn how to grow and scale your portfolio, don't miss today's show right here on Multifamily Mastery. Hey, what's going on, everybody? This is John Kasman, and you are here checking out the Multifamily Mastery Show on the Best Ever CRE podcast. I'm super excited today. We're going to jump right into things with today's guest, Mr. Paul Kaseburg. Paul, how are you today?
I'm doing great. Thanks for having me on. I appreciate it.
Absolutely. Hey, Paul, give our listeners a 1-minute bio of who you are.
Sure. So I'm MG's Chief Investment Officer. MG is a multifamily only owner operator. We have about 32,000 units in the Western U.S. And so I handle acquisitions, dispositions, and debt capital markets for MG. Obviously work very closely with our operations team and investor relations team. We're a fully integrated, vertically integrated company.
Yeah, I love it, man. Lots of great stuff there. You talked about 32,000 units, so a huge portfolio that you're managing. And you said kind of in the western part of the U.S., like what states are those that you're managing in?
Yeah, so we're in Washington, Oregon, California, Arizona, Nevada, and Denver. So
just Denver,
we've
Colorado.
Yeah, just so far, we'll get there eventually, but, we started in San Diego, and as a company, we just grew incrementally. We've always self-managed. So we kind of grow incrementally into new markets. We really try to scale there. So we're efficient. And so over the course of the last 35 years, we've just, scaled to those markets and, will continue to grow in the future to other markets as well.
Yeah, so I think what you have there is something that a lot of investors are envious of, right? So you're talking about, first of all, a long history, 35 years of the company, 32,000 units across the western parts of the United States, and you're self-managing. So you're vertically integrated. You got a ton of skill there. And you're able to run it as a big business and operate. Many of our listeners kind of run the rage from, or I should say, run kind of the scope from smaller investors getting ready to launch, trying to get their foot going, right, with their first couple of deals, to larger operators who have, hundreds of millions, if not billions of dollars of assets under management. As you think about kind of the company and you think about where you all are at today, can you talk to us about maybe a couple of the challenges that you face today and how you're looking at navigating that landscape?
Yeah, I think all of us in the multifamily business are facing some of the same challenges, whether you own a handful of units or whether you own a big portfolio. And I think it depends a little bit by market. So, certainly some legislative challenges are a risk in some of our markets, like rent control. Probably the biggest challenge that we deal with every day in our portfolio is the very high level of supply that's hitting the market right now from new development. Both single family and multi, but especially from multi right now. And so we're definitely focused on managing around that. And then the economic uncertainty right now is off the charts. And so we've been really fortunate since COVID that fundamentals have just been rock solid in the multifamily world, especially when we compare our space to other commercial real estate product types. We've been really fortunate, but if there's a recession, then obviously that's something that we pay real close attention to.
Yeah, you mentioned a couple things there, right? So first of all, you talked about just legislative challenges, looking at rent control and things like that. The second thing you talked about was just the amount of supply that's come online, which certainly a lot of investors and a lot of markets are dealing with. And then third, really just the overall economic uncertainty. And that is allowing you to really focus on your fundamentals when it comes to investing, which is allowing you to kind of navigate these challenges. Let's start with that first one, right? You talked about legislative. And when you first started talking about California and Washington, that was the first thing that went off in my head, because you got a ton of properties in these states, which I know a lot of investors would shy away from because they are such a challenge when it comes to the legislative side of things, particularly with rent control in California. How do you and your firm manage kind of that legislative process to make sure that you are staying true to the law and operating in a way that allows you to grow and continue to scale?
Yeah, I think, clearly the number one job is to make sure that we're complying with legislation. And so fortunately, when we have a platform as big as ours, we really have a great team that understands the nuances of how to manage in each of the different locations that we're in. Because all of those different, all the different states have different things that we have to comply with. And beyond even just rent control, there's just a ton of really kind of nuanced operational things that we need to make sure that we track correctly to run right. So fortunately, our team is big enough that we have attorneys that advise us on how to do that. We have best practices internally. We rely on systems that, just force compliance, right? So it just really kind of limits the ability to not comply with things. So that's something that we really focus on. And then, I think the other side of it is just trying to stay proactive with that legislative process. And I think our industry is pretty well organized. We have a really good dialogue with a lot of the folks who are making that legislation. And so we try to impact that along the way to try to make sure that it's going to be long-term as positive as possible for the housing industry.
Yeah, you talked about compliance as well as being proactive, understanding the legislative side and understanding what those laws are. But going back to the compliance side, for some of our smaller investors that maybe don't have the attorneys kind of on staff that are sitting there and tracking it, you mentioned use systems and processes. Can you just maybe give us a couple of examples and maybe, compare and contrast, like maybe something that you have to do in one market for one property that you don't have to do for other properties, and just give us a little more context of some things that maybe we can put in place to make sure our properties are in compliance?
Yeah, there are a lot of software solutions that we take advantage of. So for instance, we're a Yardi shop. And so a lot of our back end is really run by Yardi. For instance, with pricing, there are, let's say we're in Los Angeles, for instance, right? And there are specific limits on the types of increases that we can have on rents for, renewals. So those are built into our product. So we already know, we can look at, well, what are market rents? What would we like to charge for this unit if we could charge anything? And then what are we allowed to charge? And so it constrains us to only charge, what we're allowed to charge for that specific unit. And so I know there are a lot of software solutions out there, for different size operators. And we happen to be, like I said, a Yardi shop because it's a kind of a fully integrated solution for a platform like ours. But there are lots of options out there that let folks, that take that compliance risk off the table, because I think that's so important, just to make sure that you're doing things right and you don't have to worry about that, because the rest of the business is hard enough without having to worry about that, right?
Yeah, Paul, I love what you said there. And the way I'm taking it is you really want to just take that risk off the table. Don't leave it up to chance to make sure you remember what the laws are and the rules are in its market for that property. When you're setting that property up, there are a lot of solutions and systems and processes you can put in place. Take advantage of that, whether that's Yardi or some sort of software solution, or if it's something that's, maybe a little bit more, just hands-on that you have to do. Make sure you create the environment where you're not having to think about this all the time. Just set those parameters up, make it easy to stay compliant, because as you're trying to scale and you're on your own road to mastery, you have to make sure that you are doing the right thing. I lived in Chicago for a long time. I know a lot of your properties are out west. And when I invested in Chicago, we had this similar issue when it came to security deposits. And we had to make a point where at the end of every year, we had to write a check for the interest of someone's security deposit. And that was something we had to build a system in, because if you fail to do that, and by the way, this interest was like pennies, literally pennies. It might be like on a $1,000 security deposit, it might be 3 cents. And you would have to deliver this check or payment. And if you didn't, then that person could stop paying rent. You would be in violation. You would lose not only that monthly or the rent, you would lose the security deposit, and there's a punitive penalty that you have to pay as well. And it's ridiculous, but that's the law. So to create those systems and processes, you have to understand what the laws are. You have to understand the rules, but then you have to make sure you stay compliant as well.
Yeah, by the way, another great resource for owners, I think, is our local apartment associations. For instance, California Apartment Association, right? I mean, really good resources for owners to make sure that you understand, everything that's relevant for legislation in your particular market. And also, they're super interactive. You can reach out, have dialogue with them, and then they're great representatives for us, with the legislators too.
No, I love that. I appreciate that. All right. The second thing you talked about is you mentioned just the amount of supply that's come online. Do you only buy existing assets? Do you develop as well? Can you talk to us maybe a little bit more about how you manage the supply challenge?
Yeah, we, for our entire history, have only bought existing assets. We haven't done ground up development. And really, that's just a specialization question for us. So, our whole focus is we want to be the best multifamily only owner operators there is out there, right? And we want to know our markets better than anyone else. And the development process is just a whole kind of another level of risk that hasn't made sense for us as a platform. It also tends to be more volatile through kind of economic cycles. And it's a little bit harder to kind of maintain really high skill set in that development team. So for those reasons, we've just owned. And we own everything from our history has been heavy value add, older products where we go in and really, handle major deferred maintenance. We do big upgrades to units. And then we do everything up to new product that's just finishing up its initial lease up. And the mix of that it changes over time depending on what's happening in the market and where we feel the opportunities are. So we're just looking for the best risk-adjusted returns. Sometimes that's in a value-add deal. Sometimes it's in a core plus deal. And so specific to your question about supply, that's really impacting kind of the thought process around what product makes the most sense to buy right now. And what we've seen in our space is with institutional deals, about half, kind of give or take over the last couple of years of that product has been deals that are in lease up or have just finished lease up. That's been about half of the deals that have transacted. And so, one reason why we've been doing more core plus types of deals is because those are the deals that you can buy over the last couple of years. Those are actually the ones where sellers are selling. We also really like the kind of the basis opportunity on those deals. It seems pretty clear that you can buy those for well below today's replacement costs. And so we kind of like that. But when you're buying those types of deals, those also tend to be in some of the locations that are most impacted by new supply too, right? Because just by their nature. So it has been a trade-off. And I think we have to really think about each of our deals on an individual basis to say, what is the supply story for this exact deal and submarket and the radius around this deal, and then forecast our revenue accordingly. And you can believe in a great basis story and that will ultimately bail you out. But you also have to be realistic about the first couple of years of operations, given the supply pipeline that's in place. And, we talked about kind of the multifamily industry and the dynamics. Like one of the downsides of the fact that the fundamentals have been so great since COVID is the fact that it's justified a lot of new supply. So, that's just what we have to deal with. But because we have that kind of inversion where the values of assets that are trading today are below replacement cost, fortunately, that supply spigot has really shut off. And it's going to take, it takes 18 months to 2 years for that to really turn off. And we're just seeing that hit now. And so we're starting to see the supply, that pipeline come down. We're starting to see kind of operations strengthen in some of our deals that are impacted by supply. And so we expect that over the course of the next year, 18 months, hopefully, the world is going to get better in terms of managing that supply pipeline. But, at this exact moment and for the last 12 months, it's just been a lot of supply to manage. So, fortunately, over the last couple of years, we've been really, the supply pipeline has been one of the metrics that we really focus on. And so we're not as exposed with most of our portfolio as some other owners out there, because, for instance, in Phoenix, we really just focus in some of those submarkets that are insulated from supply. So we've been more in like the Chandlers and the Tempes and the Awatukes, and those types of markets. So we've been less impacted than, very far east, very far west, some parts of Scottsdale, for instance. So that's kind of how we think about some of these markets. And I think we're just now getting to that point where there's some really kind of interesting opportunities to lean into those deals that are really impacted by supply, because you can get a basis that's really attractive. We all know you can look forward and see that supply pipeline is going to shut off. And so we know how this story is going to play out over the course of the next couple of years. But it's an exciting bet in some of these markets that are high supply markets. And so, when we're looking at some other markets out there that we're not in, but we're kind of observing them, things like, Nashville or Austin or some Florida markets, right? Tremendously high supply, great basis. It'll be kind of fun to watch those unfold. And even in our markets like Phoenix, some parts of Denver, for instance, very impacted by supply. So I think that we're almost at that point where we can make some really interesting tactical bets.
Paul, I appreciate that breakdown, right? You talked about looking at supply first and foremost, understanding what's coming into the pipeline, what has recently came. And you said that, hey, over the last couple of years, around half the deals that have transacted have been new development deals, right? So these are the projects that were either fully leased up or in the lease up phase, but those deals were the ones that were available. And that's what you all have kind of locked in on. But as the supply pipeline slows down, you're now kind of stepping back and reevaluating which markets have been impacted more than others, and really identifying where those opportunities are going to be. In your role, really leading up the investment and the acquisition side of the business, how do you pivot? I mean, you mentioned that, this is, you look at every deal really based on the business plan for that project. And I get that. But I also say, hey, most of us have some sort of investing philosophy or a thesis of what we look for in investment versus just, hey, we're going to just figure out the best plan for this deal, because now you're shooting at everything, right? Can you talk to us a little bit more about kind of at a high level, how do you approach opportunities, and then how do you clarify kind of the business plan and the mission and where you think there's value in today's market?
Yeah. So our strategy really is, because we run the gamut from the heavy value add to the core plus, we still end up doing a little bit of all of it. And we have this fully, vertically integrated operations team that we can rely on. So the way I think about it is, in all of our markets, we underwrite and fly up and tour every deal that's over, call it $50 million in all of our markets, whether it's an older value add deal, whether it's a brand new, deal just coming out of lease up. And so because we're underwriting all of those, and we're tracking every deal in the market, we have this kind of ongoing sense of how much of a premium am I getting paid to buy this older deal and do a heavy value add versus buying a core plus deal and just kind of locking it in for cash flow. And so on an ongoing basis, we're always kind of making those trade-offs. Does it make more sense to take that risk? And are we getting paid for it? Or does it not on a risk adjusted basis? And so, I think for us, there are some times in the market where one strategy is kind of more commonly works for us. But the other factor is, I like to think of multifamily investing as being kind of like efficiently inefficient, and especially at kind of the institutional level. I think when we start to look down at smaller, property types, kind of mom and pop operated deals, you can find these diamonds in the rough. It's just an inefficient market, right? And there are a lot more opportunities where you can go and just kind of steal a deal. That's a little bit tougher when you're talking about $100 million deal that you're buying from an institutional seller. Like, they tend to kind of have their eye on the ball. It's not inconceivable. Like, sometimes we get some deals with some substantial opportunity, but it's a little bit less common. So, but I think about, our investment strategy is a lot of, we underwrite everything. And then we see, deals just kind of fall through the cracks. Like, sometimes deals just don't hit at the right time. Maybe there are too many deals at the same time in a market. Maybe everybody gets focused on one deal and they kind of forget about another. And so we're always just trying to pick off those deals that just don't quite make in the market. And so, I like to think about the way we invest is, you have this, overall kind of geographical strategy. You have an investment strategy in terms of value add versus core plus. And then we have this kind of knowledge of how is the tactical transaction market unfolding and which deals are pricing more aggressively than others and kind of picking off those deals that are falling through the cracks. And then we have what we really try to work on is our relationships in the market, where we have really good relationships with brokers and sellers. And this is just, over many, many years, we really work hard to always do what we say we're going to do and be the preferred buyer. And so we try to leverage those relationships too, right? With brokers and sellers. We try to be the people who always get the phone call at the end and say, hey, I want to sell it to you. What's it going to take? And so, all these different pieces of the process, we're just trying to pick off a little bit of an advantage in each one of these pieces of the process. And so over time and over many, many deals, that adds up to better than market returns. That's the way we think about it.
Paul, I love what you said. You gave some really great insights for our listeners. First of all, you talked about your investing thesis. First of all, is geographical, kind of the markets you like to play in. But because you're also looking at larger deals, right? Larger for most of our listeners, 50 million plus. The first thing you do is you analyze all of them, right? You're going to underwrite them. You're going to tour them. And that's giving you face time. That's allowing you to build these relationships with the brokers. That's showing kind of the seriousness that you all have, which certainly the track record's there. But it's allowing you to get a really strong sense of the market, and you're looking for the opportunity or the value. How much of a discount can you get? What's your basis on maybe a value add opportunity versus something that's new construction or core plus? And that's giving you a strong sense of where there's opportunity. But that's just the underwriting part, right? On top of that, you mentioned that you guys want to be the last phone call. After everybody's toured and everybody's putting their offer and maybe you haven't hit it, you want them calling you to say, what does it take to get this thing sold to you? Because we know you, we like you, trust you, we believe in you, you've got a great reputation, you do what you say you're going to do. And that's going to make brokers want to work with you. That's also going to make sellers want to work with you. And that allows you to stand out. And for all of us on our own multifamily mastery journey, there's some insights you can take with that. First of all, figure out your buy box, and any deal that fits your buy box, go tour it, underwrite it. Make an offer at a minimum. Make sure you're getting in front of those brokers, right? But you have to be present. You have to demonstrate a seriousness about these deals and opportunities. So if you're not out there and showing your face and touring these deals, you can't expect to find the great one when it comes, because you're not going to be the person they call first, right? This is going to be someone like Paul. So you've got to get in front of them to be in the game. Also, you're getting real time feedback and insights. I know a lot of people love CoStar reports and things like that. There's certainly great value in that data, but there's nothing like real-time feedback. When you're touring properties and you know what the asking price is, or you know what the challenge is, and you're seeing that live. And a lot of these, the CoStars and these kind of documents, they're all a quarter late. They're a month late or a quarter late. And you want to see what's happening real time. That's going to give you the confidence to go. You're creating your own database, right? You toured this property down the street, 3 months ago, and it's sold for this. But now you've got so much more knowledge that you actually become more knowledgeable than anyone else that you're competing with. So those are some phenomenal insights. If you can turn those into actions, it'll help you get far on your multifamily journey.
I mean, I love that summary. And there are a couple of things I want to double click on, right? So, I look at my job as everybody who we're going to buy from. I want to be able to pick up the phone and know them and be able to make that call where I'm putting a deal together. That's my job, is to know people. And it's weird because, you think about our business as I'm running a spreadsheet. I'm thinking about cash flows and what am I going to bid? But the reality is this is really a relationship business, because having that reputation as doing what you say you're going to do, that causes people to want to transact with you. We actually buy about 75% of the deals that we buy are with repeat sellers. We just closed a deal last week, over $100 million, with two very strong institutional groups. And that was fully off market because we had transacted with them before. We had a good relationship. And so, those relationships are so key. And, you mentioned underwriting every deal. I think the way I think about it is you just have to have an investment strategy where you know that better than anyone else. And underwriting every deal, what that does for us is it gives us confidence, because when the right deal comes up, you can't hesitate. You have to be able to move aggressively. You have to be able to give a timeline that's going to beat everybody else. And you have to know that market so well that you have the confidence that you're willing to do that and execute on it. And so by sort of underwriting every deal and touring every deal for over time, that's just like going to the gym, right? It's just like building that base so that when the time comes, you're ready to move.
I absolutely love it. I always say that confidence comes from preparation. This is not a fake it till you make it thing. This is not about blind hubris. This is about being prepared. If you know your market, if you know what property should sell at, you're going to spot that opportunity before others do. And you're able to move with more confidence, with more speed, because you have the actual knowledge, but most importantly, because you're prepared. So taking those steps actually puts you in a great position to build and grow your portfolio. So let's talk a little bit more about the company, right? Because one of the things that I've been thinking about here is like you have a large team across multiple states. And I know that can be challenging to run that side of the business, right? So let's move away from the real estate investing component. And it's just managing this large team, right? How many employees do you guys have? And talk to us about maybe some of the challenges that you face, kind of getting everybody rowing in the same direction.
Good question. We have about 900 employees total. That includes our team members who are on site. That's the bulk of our employee base is out on site, making our properties run. And those employees who are making our properties outperform everyone else, like that's what makes they make our investment succeed, right? And that for us, that self-management has always been our special sauce. So the fact that we self-manage, you can hire third parties to do property management. And there are times when that makes sense and it is kind of the right thing to do from an investment perspective. But having the scale in our markets and building toward that really gives us a competitive advantage because when it comes to maximizing investment value, that comes from operating a property really well. And nobody cares about a deal like the people who own it, right? And so you just can't hire somebody who cares about it like you do. So it's that part of our business is so important. And even from my perspective, from an investment perspective, we really rely on our operations team to help us make better decisions. So if I go tour a deal, it's not uncommon for us to buy deals that are across the street from deals we already own. We do that because we know those submarkets better than everybody else. And like you said, we have the confidence because we know what those rents should be because we operate right there and our team members know the people who work at that property, right? So, having that kind of like nuanced understanding is super important. It's also hard to manage. It's a lot of people. And so we're fortunate. Again, there are kind of different breakpoints to scale where different things make sense in this business, right? So I'd say property management before we had about 10,000 units, it made sense to do, but it kind of like didn't stand on its own as efficiently. And now when we're over 30,000 units, we have the scale to not only kind of do it efficiently, but really have kind of best in class tools and resources to do a particularly good job and kind of build those internally and have specializations. Like we have a team actually who focuses on pricing alone. We have a team that does marketing specifically. We have a customer relations team. And so we are constantly managing that. And it's tricky. You mentioned kind of what are some of the challenges? Well, some of the challenges are when you have everyone in a market and you're selling a couple of deals in a market, managing that side of the business is difficult. And then when you grow in another market, hiring new people is difficult too. So it's an ever evolving process in all of our markets. And so we try to manage that, as efficiently as we can. Our corporate office also has a variety of, different employees. My investments team is about a dozen people. We have our accounting team. We have an HR team. We have an investor relations team. And so, we have to kind of manage everyone here at our corporate office as well. And I guess I'd just say that, it's never on autopilot. There's always something changing in our industry. Right now, I think everyone's really thinking about what does it make sense to do on site versus what does it make sense to do on a centralized basis? And I think all large, companies were thinking about that. What can we centralize and handle here from the corporate office or remotely that can take some of the, kind of day-to-day time consuming tasks off the plate of our on-site management team. And then, what's the impact of AI on our business? And certainly, we're using some tools like Elise AI as an example at our properties to, again, try to make our on-site team more efficient and take some of those time consuming things off their plate so they can do a better job at the things that we need them to do.
Yeah, let's dig in a little bit deeper in those last 2 points, right? You're talking about one, you have, the biggest challenges are obviously when you're growing or selling an asset because you've got people who are going to be moving around the jobs there and trying to scale up the employees. But the last piece, you're really thinking about what do you centralize? What do you take from the on-site team, bring it in-house or to a central location, and then also the impact of AI. As you all are weighing kind of the impact and the decisions there, take us behind the scenes a little bit. Like, what are some of those things that you are considering either centralizing as opposed to having it with the on-site team? And tell us more about maybe some of the things you are looking at or looking into with AI.
Sure. So from a centralization perspective, I'd say there's a wide range right now of strategies for centralization. I mean, there's the traditional way of doing things where really almost everything is done on site. And then there are some groups that are really, I'd say, at the forefront of centralizing everything. And, they have, a lot of the leasing processes are brought in-house. Residents who go up, prospects, are going to self-tour at the property. They're not going to have someone walk them through the property. When they make a call to sign a lease, they're calling a central service agency. They'll have a regional maintenance team who will just go out to different properties as needed. So that's kind of, I'd say, like the more extreme level of centralization. And I'd say we fall, very much in the middle of that. We tend not to want to be the first people to do something in our industry. And we also don't want to be the last people to do something in our industry, right? So we're trying to learn from some best practices. We're talking to the folks who are really kind of pushing the limits on this and understanding what's working and what's not. And so for us so far, the centralization functions that have made the most sense are the customer care function. Works really well from a centralized, basis. We have, pricing that's centralized. We have marketing that's centralized. We still have on-site, our leasing team. So, in our properties, you're going to get toured by someone, in person. We have on-site maintenance teams, although sometimes when we have properties that are close to each other, we'll share maintenance people across those properties to make them more efficient, sort of a neighborhooding strategy. And, in terms of AI and those tools, I mentioned that we're using a Lease AI. Again, that's kind of an extra tool to provide 24/7 coverage for our properties. So somebody can call at any time and be able to get some answers to our property. But ultimately, once we get into that leasing funnel, they're going to be interacting with a human. So that's kind of where we're at right now with the whole centralization and AI process. And I'll say our industry is really slow when it comes to technology adoption compared to a lot of other industries. But things are changing operationally in our industry faster than any time I remember in my career. And so it's really exciting. It'll be interesting to see 5 years from now how things have changed. And that applies to the corporate office as well. The impacts to, for instance, accounting processes are, that's going to be impacted by AI. And there are a lot of tools that are going to make folks a lot more efficient. So, we're definitely learning along with everybody right now.
I think that's really great too, because, as you mentioned, you all have kind of a larger portfolio. So sometimes when you have a large portfolio, you have to test some things because if you make a universal change, it can have big impact on the field folks. So you do have to kind of roll it out, figure out what makes sense. And if I'm summarizing what I heard you say, it's you're starting centralizing some of the activity that doesn't necessarily impact the lease process or the sales process for the resident. So it's more customer service stuff. Make sure they have all the right documentation or getting their questions answered. But when they're truly going through the leasing process, they want to tour property. They want to, they want to interact with the people who are going to be there. The maintenance requests, that's all still on site. But maybe there's some things that marketing and other stuff like that, that's being handled more from a centralized location. So there's definitely some great intel there, and it'll be interesting for all of us to continue to monitor best practices and what's working and what's having success. I know I was talking to another operator, and they started to centralize all of their phone calls. And part of the reason this was happening is they realized that on-site person, well, if they weren't sitting at their desk or, they're getting a phone call, but they're multitasking, and you want to make sure that you can touch that person when they're reaching out, because, you might be first on the list, you might be fifth on the list, but if I call and it goes to voicemail, I'm just moving on to the next place. And maybe you missed that opportunity to connect with me. So a lot of those individuals are saying, hey, you know what? How do we make sure that we give a great first impression and a great experience? And sometimes having that on-site person do all of that can be overbearing, just simply because they may be in the middle of, talking to a resident or whatever the case may be. So it's really interesting to hear just how different groups are navigating this landscape and starting to incorporate technology in order to drive kind of greater results and a greater customer experience for their potential residents there.
Yeah, I tell you what, when rents are going up and the market's tight, you can kind of do whatever you want, and and it's less impactful. But there's nothing like a big wave, pipeline of new developments to make sure that you're on your game operationally and that you are providing the best level of service you possibly can to your residents, because that makes all the difference with leasing.
Paul, talk to me about your company culture, right? We talked about kind of, the staff and trying to grow and scale the company. I know when I speak to different business owners, entrepreneurs, particularly real estate investors, one of the challenges most of us are facing comes down to personnel, right? It's finding and retaining quality people. And I know company culture has so much to do with that. How are you able to do that at MG Properties?
Company culture is so huge because having a team that's been around for a long time just makes everyone so much more efficient. And having everyone be on the same kind of like the same mindset and the same process and way of thinking about things, it just makes sure that you're all kind of rowing in the same direction. So company culture has been really important for us. We're fortunate because we're very much a family company. So the company MG is founded by Mark Gleiberman, and he's our founder and CEO. His son, Jeff Gleiberman, is our president. And so, we're still a family-owned company. We have, one ownership. And so that makes our whole process very much smoother. So going to investment committee for me, very simple. I just go in and I sit down with the team and we talk about what we want to do, and then we do it. It's definitely much simpler than it is at a much kind of other organizations that are scaled in a different way. So we're fortunate because we've always had that all the way along. And I think that kind of that family-owned culture has always stayed with the company even as we've grown. But like with any company, we've grown over the course of the last 15 years, we've grown about 4 times in size. And so there's been a lot of scaling along the way. And, we have to actively think about how do we keep all those good things about our company culture in place as we scale and as we bring in all these new people, because, that growth requires new people. New people come in, they're not familiar with your culture. And so, it just kind of takes some time. And I don't know that there's kind of a magic bullet about that, except that I'd say that company culture, it starts at the top, right? And it needs to kind of flow down to everybody. And we all need to kind of believe in the same thing. And so there's no shortcut to that except having a vision, sticking by the vision over time. And the fact that our company has been around already for more than 30 years, we have a lot of history and a lot of strategy that's kind of embedded in the way that we do business. And so I think that really helps us continue to do what we do, because we're not a company that's just investing for the next 3 to 5 years to try to take a profit and be out. We've been building a portfolio on a tax deferred basis for 30 years, and we're planning for how to continue to build that for the next 30 years. And so that kind of mindset forces a different investment strategy. It forces a different kind of cultural approach to the business than a group that's in it for a quick buck.
On that note, what's the exit strategy for you all on a typical investment? Is it kind of a certain or predefined hold period, or is it simply just an accumulation of assets? Yeah,
good question. So we have basically 2 sources of equity. We have our private syndicated capital, and that's been our bread and butter and our kind of core equity for the last 30 years. Properties that are owned with our private capital are about 2/3 of our portfolio. And then we have our institutional joint venture deals, and we partner with, the kind of largest name brand groups out there on a joint venture basis to buy deals. And that's about a third of our deals. So the investment strategy does depend on which bucket of capital we're using. So I'll take the institutional first because that's the easiest one. It kind of depends on what they want to do, right? We're partnering with them to execute on a specific business plan. We have some that are long-term 10-year holders, low leverage, fixed rate debt. We have others that are, very opportunistic and want to be in and out. And so it's just us partnering with them so we can do whatever makes sense. With our private capital, that's where we have really a long-term focus. So our private capital, traditionally, we use 7 to 10 year fixed rate, moderate amounts of debt. We tend to use interest only loans so that we maximize cash flow and protect the downside. So we have more kind of wiggle room on the downside operationally. And we hold deals for the long term. When we get to the debt maturity, we tend to sell those deals and 1031 exchange them into another upleg. And so, we don't have a fund structure. Each deal is individually syndicated. And so over time, we have built up, we could be on our 4th generation of deals at this point, right? And so it's a tremendously powerful tool to build wealth on a tax deferred basis. It also it also impacts our investment strategy a lot because when you have 30 years of deferred gains, you really don't want to have a problem. So, we're very careful with our private capital. And I think we're super focused on, protecting our downside, managing capital markets risk. Like I said, with the fixed rate debt, that's been a real lifesaver over the last couple of years. Fortunately, we have, very few debt maturities over the next couple of years. And so, with that private capital, it's really a long-term tax efficient wealth building strategy that just kind of builds on itself.
Paul, that's excellent information. I appreciate you breaking that down. The institutional investors really going to be based upon what those guys want. I mean, they're going to drive the turns, but typically they are looking to be in and out of the deal at a shorter basis, maybe 2, 3, 5 years, something like that. But with your syndicated deals, you're typically staying those deals 7 to 10 years. And then from there, you're going to 1031 exchange into another asset. For those investors, that's a great long-term strategy. But I also imagine a number of them kind of want to cash out at some point, right? Probably not 30 years. I don't know if they saw a 30-year investment when they first signed up to partner with you. How do you kind of manage and navigate that landscape where you are holding these deals longer? And I imagine and sometimes investors do want to cash out or kind of redistribute their investments.
Yeah, that's really important is not everybody is in it forever. So typically when we sell a deal, that's our down leg, we offer our partners in that deal the option to either redeem out at that point or to stay in the deal and exchange. And typically what we see is somewhere around 85-90% of our partners want to exchange. And so that is overwhelmingly what our partners want to do. But I'm sure that those 10% who do want to redeem, it is quite important to them. So it's important to have that option for them. And fortunately, the way our model works is it allows us, when we do that sale and exchange, it allows us to provide liquidity for the partners who do want out. Although definitely the vast majority of folks are in it for the long term.
Paul, I appreciate breaking that down for us. You gave us a lot of great information today, man. I appreciate you breaking down just the way you approach the market, recognizing some of the challenges that we've all faced, particularly in your business, when it comes to legislation, when it comes to supply, as well as just the overall economic uncertainty and just how you approach, standing out in this marketplace, touring these properties, getting in front of them, underwriting the deal, but making sure that you are the last phone call. You want to make sure you have the last chance to buy the property before it goes under contract. And that allows you to stand out and really to grow and cherry pick kind of the best investment opportunities for your portfolio. You also talked about your team, how you're able to scale your team, 900 employees, what you're centralizing versus what you're keeping on site, and gave us a lot of great things to think about with how we want to manage and kind of grow and structure our own business. Again, Paul, for folks that want to learn more, they can check out your website, mgproperties.com. We'll put that in the show notes. I want to thank you for being a great guest here on Multifamily Mastery. We look forward to staying in touch with you, and I hope you have a great day. Hey, if you got some great value out of today's conversation, make sure you hit the like button, subscribe, and share this episode with someone else who may enjoy it as well. And don't forget to join the Best Ever Series community. We got a lot of great content and engagement going on over there, and you get to answer your questions and engage with some of the great hosts here like myself and learn more about growing and scaling your own real estate portfolio. Again, check that out. It's the Best Ever Series community. Just go to besteverseries.com/community.